Hello, and welcome to Principles of Macroeconomics. This is Module 4.2a, and we're going to be talking about the theory of liquidity preferences and the quantity theory of money. So, as you recall from our previous videos, we had started talking about monetary policy and the role of the Federal Reserve in determining the money supply. Remember, the goals of the Federal Reserve are to control the money supply in the economy and to regulate the banking system. The Fed's control over the money supply is also going to influence interest rates. This should be something that you've heard about already in the news, the Federal Reserve and their decisions of how to impact interest rates. Should they increase or should they stay the same? This relationship between the money supply and the interest rate is what we call the theory of liquidity preferences. We say that interest rates are going to adjust to keep money supply and money demand together. Now, from the last video that we talked about, we had the money market equilibrium, where we had the money demand and money supply graphs, as well as the value of money and the price level determining this relationship. So in this segment, what we want to talk about is how can we reconcile the graphs that we saw previously with the value of money and the price level with the adjustments in money supply impacting interest rates. Well, what we are going to see is that the money market and the loanable funds market are going to be closely related, in the sense that the interest rate effect is going to be the strongest effect that we see. So what we're going to want to do in this segment is understand how we can link the money market with the loanable funds market, so that we can explain changes in the money supply with respect to changes in interest rates. When we see adjustments in the money supply, remember, when we see an increase in the money supply, this would lead to a surplus of money temporarily at the given price level. The strongest and most prevalent way that people get rid of this surplus of money is putting that money into interest-bearing assets, so that we see a shift in the supply of loanable funds. Therefore, when we see an increase in the money supply, when we see an increase in the money supply, we see a subsequent rise in the price level and a shift out of the supply of loanable funds, leading to a decrease in the interest rate. When we merge these two markets together, essentially what we see is that an increase in the money supply is going to lead to a decrease in interest rates. On the other hand, if we see a decrease in the money supply, this is going to lead to a shortage of money. People take money out of their savings, out of their interest-bearing assets to buy bonds from the Federal Reserve. By doing so, this decreases the supply of loanable funds and increases the interest rate. So let's talk about the ways that the Federal Reserve can impact the money supply. I've mentioned a few already as open market operations, but let's delve deeper into exactly what this means. So one of the most prevalent ways that the Federal Reserve can impact the money supply is through the buying and selling of bonds to the public. This is called open market operations. The Federal Reserve, if it wants to increase the money supply, will buy bonds from the public in exchange for money. By doing so, it takes money from the public and gives the public money in exchange and increases the money supply. On the flip side, if they try to decrease the money supply, they're going to sell bonds to the public. They give people bonds and take their money in exchange, by doing so decreasing the supply of money in the economy. Another way is through setting the discount rate. The discount rate is the rate at which banks lend to each other. So if the discount rate is high, banks are not going to want to lend to each other. It's going to be more expensive for them to do so. So they'll hold on to more reserves, just in case. Therefore, the money creation process is going to be smaller. That multiplier effect is going to be smaller. So we've already discussed the role of the Federal Reserve or the central bank in determining the money supply. But how exactly can the central bank increase or decrease the money supply? One of the fundamental ways that it does this is through what we call open market operations. And this is the buying or selling of bonds to the public. If the Federal Reserve wants to increase the money supply, it is going to buy bonds from people in exchange for money. It takes their bonds and gives them money in exchange, thereby increasing the money supply in the economy. On the other hand, the Federal Reserve can decrease the money supply by selling bonds to people. It gives them bonds and takes their money in exchange, thereby decreasing the money supply. So open market operations are one of the easiest ways that the Federal Reserve can adjust the money supply. There are 3 other ways that the Fed can influence the money creation process of the banking system and therefore indirectly influence the money supply. The first is by setting the discount rate. The discount rate is the rate at which banks lend to one another. If the discount rate is high, banks are not going to want to lend from one another and therefore are going to hold on to more reserves. Therefore, the money creation process and the money multiplier is going to be smaller. Another way that the Federal Reserve can influence the money creation process is through setting reserve requirements. And they'll set a minimum of reserve ratios that the banks have to hold. If that minimum is high, then the money creation process is going to be smaller because the banks are going to be required to hold on to more reserves. The Federal Reserve tries not to change the reserve requirements frequently because it can disrupt banking business. And lastly, the Federal Reserve can choose to pay interest to the bank's reserves so that the higher the interest that they are paying to banks, the more reserves the banks will hold. Therefore, the smaller the money creation process is. These last 3 steps are a way for the Federal Reserve to impact the creation of money in the banking system and indirectly influence the money supply. So what have we learned in this segment? Well, we've learned how we can link changes in the money demand and money supply model to changes in the loanable funds market, thereby linking changes in money supply to changes in interest rates, so that we know when the Federal Reserve is trying to influence interest rates, it's really doing so through changes in money supply. We've seen the tools, and we've discussed the tools by which the Fed can change money supply directly or indirectly. Thank you so much for joining me in Module 4.2a.